if you own dollar denominated assets, let's say you own a company that has a lot of dollars but has no gold, right? Let's say a bank, because banks don't have gold. They can store gold for other people, but they don't have any gold of their own. So banks have no money, they have credit. So let's say you own stock in Wells Fargo or Bank of America. Just use the examples of banks that I came up with at the beginning of this interview, and they're in my brain now. So they have no, if these banks have no dollars and the value of credit goes to zero, if you have stock in Bank of America, it goes to zero. I mean, we've seen that before, banks stocks going to zero. So if you have a big portfolio of stocks that are dollar denominated, they'll go close to zero. If you have deposits in your bank account, your checking account, they'll definitely be worthless. Either you won't be able to take them out, or you will be able to take them out and they won't be worth anything. Either way, it's the same thing. If you have a lot of money, meaning you have a lot of liquid commodities somewhere safe, not in a bank because they'll steal them, then all the purchasing power that is now in credit, what I mean by that is there's a certain amount of credit in the economy, right? And theoretically, all of that credit can buy all of the stuff in the economy.
Farber begins with a powerful metaphor. The global monetary system is an inverted pyramid. At the base of this structure lie a shrinking pool of actual dollars, not money, mind you, but fiat currency, exchanging hands in what he calls the monetary sewers. This is where the real corruption and dysfunction lies. Every night, trillions of dollars change hands through complex financial instruments like repo transactions. On June 30th, for example, $2.8 trillion moved between banks. This isn't normal consumer activity. These are leveraged automated trades, such as arbitraging treasury futures, that make banks a few cents per trade, which they multiply up to millions through leverage. The problem? The total U.S. banking system only holds around $3.3 trillion in reserves. When trillions are being shuffled around daily, this leaves a dangerously thin margin. Should anything disrupt the flow, like the U.S. Treasury pulling cash from reserves, the whole system teeters on collapse.
This is the tip of the iceberg of what I do. I'm more of a monetary philosopher explaining the nature of money, but we can start at the end and then maybe we'll go to the beginning. But the end is, look, we're on a giant pyramid. We're on a giant inverted pyramid, and there's a basement of money, of dollars, I'd say, not really money, of dollars that exchange hands every night in the sewers, in the monetary sewers. It's really yucky and disgusting down there, full of corruption and craziness, and it smells bad and all that other stuff you find in sewers, rats and whatever. So what's happening is $2.8 trillion changed hands yesterday. And today it's going to be, I think it's going to be a new record because we're on June 30th, and record amounts of money change hands between banks on month ends. And this is a quarter end because I think this is the end of Q2, June 30th. So I'm betting we could see $2.9 trillion, maybe even $3 trillion. Now the question is, where do those dollars come from? And the answer is they come from bank reserves. And why are they changing hands? Well, there's a whole bunch of bets that are being placed every single night in the using repo dollars, using these dollars that change hands between banks in order to place bets on treasury futures and then sell the futures and buy the spot and whatever it is. It's like these stupid trades where banks get a cent or two per trade and then they multiply it 50, 60 times and they end up with millions of dollars free money every night doing this. So if we have $2.93 trillion changing hands every day, and we only have about $3.3 trillion in reserves, that's not a big buffer zone. You can't have more dollars changing hands than dollars that are available to change hands. So the minute that the debt ceiling is raised, that means the government or the treasury is going to have to suck dollars out of those bank reserves and then spend them on a bunch of crap. And then there will be fewer bank reserves and fewer dollars to change hands. So all of those banks and hedge funds or whoever's doing it that are making those penny trades and multiplying it 50, 100 times over, if they run out of money in the repo market, those trades all have to close at the same time because they can't be funded, and then you have a crash. So once the Treasury, here's the crux of it, once the Treasury has to raise more money by adding to the debt and sucking bank reserves out of the system, there's not going to be enough dollars for the repo market to fund the basis trades that are happening every night. And the Fed is going to have to invent the difference. That's quantitative easing. There's no step down method of these huge trades. Once they build and build until they crash, which is what happened in 2019. And it's going to happen again shortly after the debt ceiling is raised, which is whenever this big, beautiful bill is passed, which has, pornographic connotations to it, thanks to Donald Trump. And it's going to be the end of, it's going to be, I don't know, the end of something. It's going to be the beginning of the next quantitative easing round. And from there, I think the dollar is going to be destroyed shortly afterwards. Could I be wrong? Yeah, I could be wrong. There could be some kind of other rabbit that I haven't counted, but I don't see it. I don't know exactly how quickly, but now we're splitting hairs. It could be 2 weeks, it could be 7 weeks, it could be, 18 weeks. I don't know. It doesn't really matter. I mean, in the scheme of things, well, I can just tell you what the numbers are, and then you can make your own calculations. There's $300 billion left in the Treasury's bank account at the Fed. They could theoretically run that down to near zero and then start raising debt and then sucking out of bank reserves, or they could start sucking out of bank reserves immediately, which is, I think, what they will do. So, when they start taking money out of bank reserves and putting it in their bank account, once the money is in their bank account at the Federal Reserve, they have a checking account. Just like everybody has a checking account, but it's a special checking account. It's a checking account that is not counted as part of the money supply. Our checking account, my checking account at whatever bank, Bank of America, Wells Fargo, whatever, your checking account, right? Your bank can lend out those deposits because it's a fractional reserve. It's not even a fractional reserve bank anymore. It's a zero reserve bank because the reserve requirements are zero. So they can take your money and they can lend it out, and hopefully they didn't lend out everything. So when you want to take cash out of your account, then they just, take it from somebody else, give it to you, and then it's all a big mess. But in their special checking account at the Federal Reserve, nobody can lend out their deposits. It's illegal. It's not part of the money supply. So once they suck the bank reserves out, nobody can use them. Not a single bank, nobody. So that becomes out of the money supply, outside of it. No more in the money supply. So it'll go back into the money supply, yes, when they spend it and give it to another bank to buy bombs or to buy welfare or whatever the hell they're doing, to pay social security checks. Who cares? So when but in the meantime, when the money is in their checking account and not at another bank, it can't be used. So if you look at the size of the Treasury's banking account, I think it went up to like $800 billion or even over $1 trillion in 2020. And it's at 300 billion. So if they raise it to, like, let's say 800 billion, 700 billion, that's 400 billion less reserves than there are now. And there's 3.3 trillion. So you take away 400 billion from that, you have 2.9 trillion in reserves, supporting 2.9 trillion in repos. That's getting pretty close. That there's not enough. So that's why I say weeks. I don't know how many weeks. It doesn't matter. It's close.
Farber ends by challenging a common gold bug mantra that gold is the only money and all else is credit. While largely true, he adds nuance. Money is not binary. It's a continuum based on liquidity within a given system. In prison, cigarettes might be money. On Earth, between nations, gold is the most liquid and universally accepted asset. That's why it stands as the best form of money in a global context. But ultimately, money is just the most tradable good, and gold holds that crown because of centuries of trust, scarcity, and utility.
I don't know if it's monetization of debt. I'm just saying that there are some banks that don't have cash, and there are some banks like JP Morgan that have a whole bunch of cash. So let's say JP Morgan lends out its cash to these other banks so that their clients can borrow it through the repo market and then use it to fund Treasury futures trades. I'm not talking about monetizing any kind of debt, but in order for the dollar supply to be added to, how it's done is that the Fed buys treasuries, because they could buy anything. They could buy my chair. They could buy, I don't know, Harry Potter books. It doesn't matter. As long as those dollars are added to the system, it doesn't matter what they buy. Then then the dollar becomes backed. The word we use is backed by whatever assets they buy. If they buy my table, if they buy my couch, then the dollars are backed by the value of my table and the value of my couch. It just so happens that when they buy treasuries, the dollar becomes backed by the asset that they're buying. Like, the dollar is a liability unit. A liability unit has an asset on the other side. The asset on the other side is mostly treasury debt. but treasury debt is the promise to pay those same liability units in a circle. And so you have an inflationary loop that if it doesn't keep expanding, it collapses in on itself like a black hole. So you have like what we're, the situation we're in, I guess, astronomically, is a neutron star, where you have a star that's just dense enough to maintain its volume without collapsing into nothingness. But if it gets any more dense, it just collapses in on itself, and there's a black hole, and then it disappears, and you have an infinite density unit called singularity, and that's where we're headed. So what happens after the singularity? The dollar goes away, nobody uses it anymore, and we have to go back to what money actually is, which is gold and silver. I mean, credit goes away. When credit goes away, money goes higher. The dollar is credit, it's not money.
No, absolutely. All else is credit, right? Gold is the only form of money. All else is credit, is the famous saying here.
It's not the only form of money. I'm just to be a little bit nitpicky on that. It's not the only form of money. There's no singular form of money. There's no one thing that's money and another thing that's not money. Money is a continuum. It just has to do with degrees of liquidity of whatever commodity. So the best money is the money that's the most liquid in a given economic system. If we're talking about a prison, it would be tins of mackerel or cigarettes, because that's the only thing that's allowed in there. But if we're talking about the entire planet, then the most liquid commodity between nations is gold. It just is. For whatever reason it is, it is. If you own dollar-denominated assets, let's say you own a company that has a lot of dollars but has no gold, right? Let's say a bank, because banks don't have gold. They can store gold for other people, but they don't have any gold of their own. So banks have no money. They have credit. So let's say you own stock in Wells Fargo or Bank of America. I just use the examples of banks that I came up with at the beginning of this interview, and they're in my brain now. So they have if these banks have no dollars, and the value of credit goes to zero, if you have stock in Bank of America, it goes to zero. I mean, we've seen that before, banks' stocks going to zero. So if you have a big portfolio of stocks that are dollar denominated, they'll go close to zero. If you have deposits in your bank account, your checking account, they'll definitely be worthless. Either you won't be able to take them out, or you will be able to take them out and they won't be worth anything. Either way, it's the same thing. If you have a lot of money, meaning you have a lot of liquid commodities somewhere safe, not in a bank because they'll steal them, then all the purchasing power that is now in credit, what I mean by that is there's a certain amount of credit in the economy, right? And theoretically, all of that credit can buy all of the stuff in the economy. So if the value of that credit goes to zero, it's not like the stuff goes to zero. There's still stuff here. It's not like if we have a dollar collapse, every house blows up. It's not a nuclear war. It's a financial crisis. So that just means the shifting of purchasing power. So purchasing power shifts from credit to money. Credit is the dollar. Money is gold, right? The value of credit is based on money. That's where it comes from, that in the past, and all prices have to go into the past, or else there's no connection to the past, and therefore prices are meaningless. So for people who have money, it will look like a humongous shift of purchasing power into their pockets, and a humongous shift of purchasing power away from very powerful people, which on the one hand is good, on the one hand is extremely dangerous, because extremely powerful people, when they suddenly have no money, they get very upset, and then they start doing things that we don't like.
Rafi Farber delivers a chilling but clear-eyed analysis of a collapsing monetary regime. From repo market vulnerabilities to debt ceiling chaos, from QE illusions to dollar singularity, he lays out the unavoidable consequences of our credit-driven financial structure. The conclusion is simple: the system cannot be saved, only delayed. If Farber is right, then the countdown has already begun. We're just weeks away from another seismic shift. Whether you're a seasoned investor or a curious newcomer, the takeaway is clear. Own real assets, own gold, own silver. Get your wealth out of the credit system before it collapses. Please like and subscribe.